Hi everyone. In this session, we are going to discuss something very interesting and interactive. The topic is identifying accounting red flags. Red flags are like alarming things which you have to really take care about and you have to be really cautious about that topic. Identifying accounting red flags can also be termed as forensic auditing. So hope you have gone through all my earlier videos wherein I have mentioned about various financial statements like balance sheet, profit and loss statement, cash flow statement, etc. Even I have mentioned in detail about the annual reports. So understanding those things are very vital before watching this video. So if you have not watched those videos, I request you to go through the videos, then come into this so that this becomes meaningful for you. So simply speaking, financial statements gives us all the brief about the financial activities undertaken by the company in that particular financial year or in that quarter. It reveals how a company generates revenue, generates profits, utilizes its inventory, plans its asset allocation, what is its assets and liabilities, how the company utilizes the capital expenditure, so-called capex, for generating cash flow, what is the cash flow, what is the cash generated by the company, etc. But these financial statements, which is recorded in the document, may not be always transparent for all companies. Management always tend to utilize the loopholes in the accounting practices to misinterpret or manipulate the financial statements. Accounting red flags are signs of potential trouble that company is having, and really the investor has to be very cautious in understanding these red flags before investing into such companies. There can be various misinterpretation and omissions which can be done within the guidelines of the existing accounting practices, and the techniques are easily available which are prevalent as per the current standards. And in some cases it can be a financial fraud as well, but for understanding such financial frauds in advance requires great experience and skills. So by identifying such financial frauds or red flags, accounting red flags in advance, the investors has to stay away from such fraudulent companies to avoid potential wealth erosion. So the question, why do they do it? So mainly the corporates do this out of immense fear or greed. The management or the managers have got lot of incentives and profit sharing margins based on the revenues and profits generated by the company. So they tend to inflate these revenues and profits fraudulently to get those incentives, but finally becoming a fraud case. Also reporting inflated, overinflated, or fraudulent profits in the financial statements or good performance of the company in the financial statement helps them to get better interest rates from the lenders, and also this helps a company to have a good faith in the investors, and also inflating the market price or market capitalization of the company which is listed in the stock market. Also, as I have mentioned in my earlier video on money laundering using stock market, so there also I have mentioned that these promoters utilize these techniques by which they inflate the price of the stock by showing fraudulent figures in the financial statement, and by inflating the price of the stock they use this laundering method to sell off the stock and liquidate the stock and get the profits which are actually in a bubble territory. So that is how they siphon off the money from the overinflated stocks. Another thing is that once the stock prices are overinflated, they pledge these stocks, and the funding which they have got from pledging these stocks, which is lent from probably the lenders, is being utilized by them to fund the sister company expenses or the projects undertaken by the sister companies or the subsidiary companies. And this pledging would not have been possible if the price was very low, and these fraudulent figures helps them to overinflate the stock price, and pledging really helps them fund the businesses they want to fund. There are many companies who are doing this. I cannot name them because of legal constraints, but this has to be kept in mind while analyzing a stock. So now directly getting into how we can identify these accounting red flags. Forensic audit is a subject in itself, so it's a huge vast topic, but I will concentrate my discussions only on analyzing the important accounting red flag practices which we have to analyze while going through the balance sheet or annual reports of the company. You really need to concentrate while I am talking on the topics. You can write down the points in your diary and understand, analyze the real case scenarios in parallel. First one is fraudulent related party transactions. So this topic actually I have covered in my analyzing the annual reports video, but still I will decode much more about the related party transaction with ample example. So typical related party transaction includes: first, providing loans at lower rates to the insiders; providing grants or donations as cash to other firms controlled by promoters. And third, utilizing the cash of the firm to buy stakes in entities promoted by friends or families of the insiders. So there are other fraudulent transactions as well, but majority three are these. An unusually large number of such transactions of related party is a real concern and a red flag for the investors. Now let us take an example wherein we can decode this topic. The Satyam scam, which is India's biggest corporate scandal. So this comes with the revelation of CEO of Satyam, Mr. B. Ramalinga Raju, who confessed in his letter to SEBI that the figures in the financial statement has been falsified. The account has been falsified to an extent of 1.47 billion US dollar. What he did was that he had created numerous bank statements. Bank accounts has been falsified, and it was shown to fraudulently project that there are a lot of money available in these accounts. Income statement was also inflated by showing interest income from such non-existing fraudulent bank accounts whose interest rates were shown as part of the income statement of the Satyam balance sheet. Around 6,000 salary accounts were created over the years, which was actually belonging to the promoter itself, and the money was deposited in that, and this money was utilized for funding his personal needs. Even fake invoices was made to inflate the revenues. Even the board resolutions were forged, and this was utilized to avail new loans. The cash raised through American Depository Receipts, that is ADRs, in US was also siphoned off. The scam, which began in early 2003, was only intended to siphon off the majority of cash into the accounts of Mr. Raju. The intent was to siphon off huge sums of money into his own firms so that the cash can be utilized for his personal needs. Two such firms were Mehta's Properties and Mehta's Infrastructure. In December 2008, the board of members of Satyam decided to acquire these two firms. The reason provided by the board to the investors is that the company wants to diversify its business, so that is why they are acquiring these two firms, which are Mehta's Properties, which are into real estate, and Mehta's Infrastructure, which is into infrastructure development. The main reason for acquiring this in reality was that the major stakes in these companies, more than in Satyam, for Raju, was in these companies. So once they are utilizing the cash available with Satyam to buy these companies, he can easily siphon off the money from Satyam books into these fraudulent companies, wherein he can easily siphon off that money directly through acquiring these companies. But upon hearing this news, the stock price of Satyam crashed so high that the transaction of these two companies which is to be acquired was aborted. When this scam completely came out in 7th Jan 2009, the stock almost tanked 82%. Mr. Raju had utilized this siphon of money to buy various real estates and develop various infrastructure projects, mainly in Hyderabad, with the help of politicians and bureaucrats. Second red flag is distortive depreciation practices. Company assets like plant, equipment, and proprietary technology have got long useful life. Accounting laws actually allows the purchase of such high budget items to be spread, means the cost incurred for buying such high budget items can be spread over several number of years, so that the amount which is utilized to buy that item is not shown in the first year itself. So this is listed under depreciation. Some companies manipulate this figure and takes it too far, even beyond the years by which the equipment useful life is already ended. They may use small depreciation in a few years, wherein the company is making lesser profit, so that the overall profit is good, and wherein if the company is making a good profit in particular years, in only those years a higher depreciation value is allocated for the depreciation of that equipment, and this helps manage the or fabricate the profit generated by the company in reality. So if a depreciation value is lesser, then the profit figure also gets larger, and if the depreciation figure is higher, then the profit gets lesser, because end of the day it is subtracted from the profit, because the same being an expense for buying that particular equipment. So in fact, if you distort the profit figures, this will affect the ratios also, like EPS, PE, etc. So you will be completely misguided on analyzing on a particular stock valuation. So as a responsible investor, while investing into a company, you really need to know the fluctuations in the depreciation figure, and also you have to reevaluate the various assets owned by the company on a yearly basis, or maybe in a 2-3 years basis, so that you have to really evaluate whether this depreciation figure is correct or not. A typical example for this, I would state the case of Jet Airways. In first quarter of financial year 2009, they had an operating loss of 562 crore. But if you see, they had a net profit of 143 crore. This was actually done by write-off of 916 crore on account of depreciation. Another forensic audit or the red flag which we have to be very careful about is misrepresentation of revenue and costs. Mainly this heavy engineering and infrastructure companies widely use percentage of completion method for revenue recognition. It is used in case of execution of longer term projects which is extending beyond one accounting period, which is one financial year. The revenue recognition is represented by percentage of work completed, often on milestone basis, divided by the total project value. Revenue, cost and profits are recognized based on percentage of completion of contract activity at the end of each accounting period. This method can be easily utilized by companies to overstate its revenue figure. Many times, company or the management would be under pressure to show or meet the revenue expectation by the analyst or the investors or the market expectation, to meet the market expectation. So this revenue is being adjusted for various quarters or year basis to satisfy the market requirement. Actually, company can access the work completed at their own discretion and also raise bills to the customer against that completion of work. At the same time, they can easily recognize the revenue in the balance sheet and also increase the debtors by the same amount. However, the approval of the entire amount is based on the criteria as defined by the customer for the particular milestone. Non-acceptance by the customer can also lead to reversal. But however, we will not be able to identify this because by the time it is reversed, the company will keep on doing the same practice of billing the other customer. So though the earlier customer has not cleared the payment, the reversal can happen, but that will be transferred to another customer in the form of new bills, and this continues and you will not be able to identify the reversal of the payments. So only way by which we can identify is to see the receivables. If the receivables is increasing than the regular standard or normal practice and it is taking longer time to convert to cash, this will be clearly mentioned in the cash flow statement under the operating cash flow head, where there will be working capital adjustment, where the receivables will be mentioned. And even though the profit before tax is higher compared to the previous year, because of these receivables, large amount of receivables and inventory, working capital cost becomes higher and this will reduce the effective operating cash flow. So though the profit earned by the company is not being converted into real cash, this is a red flag indeed. And many times cost overrun by the company is also another thing which has to be taken into account, because if the cost overrun is there, then the effective revenue will be lesser and it would be an overstated revenue. But however, the realization of the cost overrun will be only towards the end of the project, which we cannot identify. Exceptions can be some accounting practices wherein the company recognizes the revenue only after acceptance of bills by the customer. This is a conservative revenue recognition policy, but majority of the companies doesn't follow this, just to overstate the revenue. The fourth one is working capital management issue, which already we have discussed in our earlier videos. But again, as we are going through the various forensic audit points, this is one of the major things. Increase in debtors and inventory is a major sign of company having working capital concerns. This can really impact the balance sheet and companies may have to borrow to suffice to the working capital requirements. This I have earlier mentioned in companies like J-Kumar Infra, Navbharat Limited, or both are my holdings, but still these were some concerns in those companies. But also it is to be really noticed that like J-Kumar Infra, it's a capital intensive company into huge infrastructure projects. They have got a lot of projects in pipeline as well. So such companies who is expanding its business in a very fast rate and scaling its business will require a lot of capital intensive requirements, and also the sales goes high. So in such business, it is quite obvious to have increased inventory and debtors. So we have to consider the business as well, whether it is scaling or is it in a takeoff mode, and then we have to analyze both these factors and then decide whether this is a real red flag or not. I would say the best way to analyze this is to look at the inventory turnover and debtor turnover ratios. So inventory turnover ratio is depicted by net sales divided by inventory. I repeat, the inventory turnover is calculated by the ratio of net sales divided by inventory, and debtor turnover is represented by the net sales divided by the account receivable. So a decrease in this ratio over a period of time indicates that there is a build-up. So this is a clear case of working capital concern. So in capital intensive businesses like infra, the cycles are longer. So as I mentioned, we have to really go deep in evaluating and finalizing whether this is a real red flag or not. Fifth point which I would look at is contingent liabilities. Contingent liability is a liability which is defined based on a future event. So this contingent liability is not normally listed under the liability in the balance sheet, but in the footnotes, you can see that particular contingent liability figure. If there is any fraud making in the contingent liability derivation, then this can be a real red flag. So again, I take an example of a company, Sri Ganesh Jewellery House Limited. These are manufacturer and exporters of handcrafted jewellery. Prima facie, if you look at the books, it is having a clean book. The company seems to have a good financial number. It has recorded healthy ROE year on year, at the same time paying off debt and reducing the debt equity ratio. So prima facie, if you see those ratios, all of them are really healthy. But if you take a deeper look into the company's books, it presents a really 180-degree different story. The company had a contingent liability of around 19.6 billion rupees in financial year 2013, of which nearly 14.9 billion rupees were on account of bills discounted. So bills discounted is nothing but the money which customer owes to the company and which will be paid on a later date. Ideally, the company should record this under receivables or debtors, but instead they have mentioned this in the discounted bill with the bank and takes money on a date earlier than the due date. The contingency is that if the customer defaults after the due date, then the bank will encash the amount from the company. But in such a case, the company's debtors and hence the debtor days should be coming down, right? But as we look deep into it, for the past 5 years, the picture is completely different. While the contingent liability was increasing due to increasing amount of bills discounted, at the same time, debtors days also has been rising up. So we should be really cautious about such companies. Sixth point which I would be looking at is very clearly is to concentrate on the cash in the books. So again, taking the case of Nava Limited, the the revenue has increased, the profit before tax also increased year on year. But if you see the cash flow from operations, it was reducing because, as I told, the inventories and the receivables was increasing. So this is that the amount is billed to the customer and customer has not paid them back. The payables, which is the amount which is to be paid to the vendors, already they have paid. So this is like there is some working capital concern. So because of this, the cash flow from operation reduces. So the effective cash flow or the free cash flow reduces. So as the free cash flow is nothing but the operating cash flow minus the capital expenditure, capex. So as the CFO, the cash flow from operation reduces because of this working capital higher requirement. So even though the company is making good profit, it is not being converted into cash. So cash is king. So this is also important red flag which we have to consider. Now in case of Nava Limited, I have already mentioned that there was some issue regarding the payment to be got from the Zambian operation ZEPCO. So that is cleared in the court in the London, in the UK court, and they have got the money recently in December. They have got the clearance on getting that money. So by August 2023, all the amounts will be coming into the books of Nava Limited. So they are out of that working capital issue. So that is totally different. So you have to see case by case. It is not that it's a red flag and you have to completely avoid the company. You have to look into the pain points of the company and find undervalued small caps like this and invest at the right time. Also, the seventh point is like you should be looking at all the notes and footnotes in the annual report and in the financial statements, which is annexed to the financial statement, because these notes really has got figures and facts which we really need to dig into, which will really help in a real or true forensic auditing. Also, another point which I will tell you is that you should look into the large mergers and acquisitions and frequent capex requirements raised by the company. This is again not a red flag, but you need to look into whether they are really going for a good M&A operation, or whether the capex is really utilized for a business which is profitable in nature and whether it will really bring in cash into the company accounts. Also, a frequent change in auditors of the company and also the chief financial officer CFO of the company is a big red flag for me, because it is that there is something fishy going on and these people cannot reveal it because of some pressure, and they are supposed to resign and the new guy comes in and again the same thing repeats. So this is a great red flag for me, and I will really look into it while exploring through the annual report. Also, extensive group companies, if it is there, not like Tata and all, but some other companies who have different groups like this, like what we discussed for Satyam regarding the Mentas group. So these things we have to really look into and study what business they are really into and is there any fishy thing going on there. The final thing would be promoter pledging, which we have already mentioned. So pledging of the shares is to a small extent it is okay, and if it is really required for funding some real needs which will expand the business of the company, scaling the company to higher heights, is okay. But if it is not for real cases and just a fraudulent case of siphoning money, then this really has to be looked into and you should completely avoid such companies. So forensic audit, though I have told in a very brief manner, I'm sure that if you have understood all these points clearly, these things are only important while analyzing a company. And if you are really thorough on these topics and if you keep analyzing various annual reports and financial statements, then you will be thorough on the various points which I have told. while going through real case analysis, and this will really help you find out gems in the dust, which is especially the small caps, which are good bets, and this will help you create multi-bagger returns over the period. Hope this video was helpful for you. See you in another video. Till then, happy investing.